Hey, Cash Course fans! Before we start the show, remember that you can get hundreds of free educational videos for all ages at PragerUkids.com. Subscribe today and never miss an episode.
We all know when you increase the air pressure in a balloon, it'll expand. Decrease the pressure and it'll contract. When you lift weights, muscles contract, then expand when you relax. But did you know that an economy also has natural cycles of expansion and contraction? This means there will be periods of more economic activity and periods of less. Most economies also have some sort of government intervention that attempts to stimulate or restrain activity. These are often called economic policies, and there are two types: monetary and fiscal. These policies can impact prices and the availability of goods and services from the grocery store and the gas station to buying a car or starting a business. Let's take a closer look at each of them separately. First, monetary policy. This refers to the actions taken by a country's central bank to try to stabilize an economy, control inflation, and manage a nation's money supply. Money supply is simply the total amount of cash and other liquid assets that can be easily converted to cash. In the US, the central bank is known as the Federal Reserve, aka the Fed, and their actions have consequences on the flow of money both locally and globally. The key tool of monetary policy is changes to the federal funds rate, which is the interest rate at which banks lend to each other. This rate influences other interest rates, including those for credit cards, savings accounts, and loans. Changes in the federal funds rate affect the money supply in the economy. Raising the rate has a contractionary effect on an economy, reducing the money supply by making borrowing more expensive and saving more attractive. On the other hand, reducing the rate has an expansionary effect, increasing the money supply by making borrowing less expensive and saving less attractive.
How does this affect me?
Well, say you have $100. The bank offers 5% if you deposit it in their savings account. But you're also thinking about investing in the next hot stock. Since there's generally more risk investing in stocks than depositing in a bank, you'll probably want to earn more than 5%. This same incentive plays out when it comes to the federal funds rate, where banks lending to you for a student or car loan will want to earn more than what they can get from lending to another bank. So, the higher the federal funds rate, the higher a bank will charge you to borrow the money, and vice versa.
So how does the Fed set the rate?
Technically, the Fed doesn't set the rate, but they can manipulate it through other monetary policy tools. But that's another episode. Fiscal policy, on the other hand, refers to legislative or executive government actions that influence the flow of money in an economy. Actions include increasing or decreasing government spending and adjusting tax rates and tax policies. Each of these can cause an increase or a decrease in economic activity. For example, increasing taxes on fuel, like gas, will increase the cost of energy. This is a contractionary policy, reducing overall demand. On the other hand, decreasing taxes on fuel will reduce energy costs. This is an expansionary policy, increasing overall demand.
But why intervene at all?
It's mostly because the government is seeking a particular outcome, whether creating new social programs or simply redistributing money to prop up certain institutions or industries. Unfortunately, the process to achieve those outcomes is often costly and inefficient. It also usually creates additional issues. For example, say the government decides to give everyone money in order to stimulate the economy. This leads to more spending on things like stocks, electronics, and other goods and services.
Isn't that a good thing?
Well, this creates more demand than there otherwise would have been, putting upward pressure on prices. Unless there's a correlating increase in supply, multiple fiscal policies like this implemented over time will push prices further upward. If prices rise too much, the central bank will often intervene to try to control the inflation. This includes raising the federal fund rate, which encourages saving over lending by banks, and discouraging borrowing and credit for consumers. This is an attempt to slow down the flow and supply of money.
Does it work?
Well, while often well-intentioned, the effects of policies are often delayed and could even create the opposite result of their intention. Almost 100 years later, there's still debate whether the Great Depression, the worst economic episode of the 20th century, was extended due to the government's fiscal and monetary interventions. But what's not a debate is that an economy is often tied to the political situation of a country or region. Fiscal policies often change when new leaders are elected. A central bank, ideally, is supposed to be independent from the government, but they're greatly influenced by the political party that's in control. In today's interconnected economy, monetary and fiscal policies can have both local and global consequences, from starting a business to buying groceries. The more you understand the trade-offs and effects of those policies, the better decisions you'll make when you buy, when you invest, and when you vote.
Muscles contracting. Ugh. Expand! Expand!
Watch more at PragerUkids.com. And parents, don't forget to subscribe.